In Ireland, there are two rates at which income is taxed. The standard rate, which is 20%, and the marginal rate, which is 40%. The amount of income taxed at each rate is determined by tax rate bands. These bands are based on the personal circumstances of the individual, or the couple being assessed. The standard rate tax bands are as follows. For a single person, the first €35,300 of their income is taxed at the standard rate of 20%, and the remainder at the marginal rate of 40%. A single person with dependent children has a greater tax band. The first €39,300 of their income is taxed at 20%, and again the remainder at the marginal rate of 40%. For a married couple with just one income, the standard rate tax band of 20% applies to the first €44,300. Once again, anything above that will be taxed at the higher rate of 40%. Finally, for a married couple with two incomes, the first €70,600 of the combined income will be taxed at 20%. This is provided the second spouse's income is at least €26,300. If the second spouse earns less than €26,300, then the band will be €44,300 plus the income of the second spouse. Now let's take a look at tax credits. Everybody is entitled to them. They are amounts of tax deemed to have already been paid and are therefore deducted from a person's gross tax liability. There are two types of tax credit: refundable and non-refundable. If refundable credits exceed the tax liability, the difference is paid as a refund. However, if non-refundable tax credits exceed the tax liability, there is no refund. The excess is lost. Now, let's look at just a few examples of refundable and non-refundable tax credits. Finally, now that we have looked at what tax rate bands and tax credits are, we can take a look at what a very basic income tax computation looks like.